All right, welcome to DTNsights. We're at an interesting point in the growing season. The July WASDE report is just behind us. Crops are entering into their most critical development stages, and weather is becoming an even bigger factor in where this year's crop ultimately ends up. Today, we're going to talk about those latest numbers, but more importantly, how agribusinesses can use both USDA data and DTN intelligence to make better decisions before the next government report is released. Joining me today is my namesake, Rhett Montgomery, lead ag market analyst for DTN. Rhett, welcome.
Hello, Gray. Thank you so much. Good to be here on the podcast. It's been a long time coming to record this, and really happy to be here. Been looking forward to it.
Cool. All right. So tell us about your job at DTN. What are you seeking to accomplish each day?
So as you mentioned, I'm DTN's lead market analyst. I've been in this role almost 2 years. Started in October of 2024, taking over my predecessor, Todd Holtman, who retired. Prior to that, just some of my background, I did work as a grain merchandiser for several years. Prior to that, in central Nebraska, trading grain primarily in Nebraska, but also across the western corn belt into Iowa, Kansas, and Colorado. Ultimately, in that role, while I enjoyed trading grain, was looking to get more into solely focusing on the product or farm product marketing side of it, the analytics side of it, and ultimately being able to track markets every day, track data every day, and discern helpful information that can then be relayed to producers to improve their bottom line. Ultimately, the best part of grain merchandising was obviously interacting with the customers day in and day out. And I did do a brief stint at a brokerage, thinking maybe that would be the avenue to get more involved with direct marketing with producers, but ultimately just felt that being able to focus solely on analytics and more in an almost journalism sense, being able to share those insights would be the best way, just with how I am personally wired to help producers across the U.S. as best we can. And so that's in a nutshell what I've attempted to accomplish today. Me and also our team of analysts here at DTN are covering row crops as well as cattle markets day in and day out, pretty much 24/7, and sharing what insights we can in multiple writings each day and weekly and monthly, and hoping to translate that ultimately into the bottom line of our subscribers at DTN.
Yeah. All right. Well, so now you're a big media star with us. Before you were here, you were grain merchandiser for whom?
I worked for the Andersons grain out of Kearney, Nebraska. So I grew up interestingly on a alfalfa farm and cattle operation just west of Kearney, Nebraska, in a town called Cozad. My dad ran a D-high pellet mill, which is kind of a interesting niche area of agriculture. So interestingly, I didn't grow up per se on a specific row crop, corn, soybean, and wheat farm, but obviously was around it all through my youth and adolescence. So went to the University of Nebraska, ended up back in the middle of my home state, but live down in Oklahoma now, so I'm still trying to figure out how that happened. Really enjoyed my time at the Andersons. Like I said, that it's still part of me will always have a passion for the logistics of grain and how grain moves through the countryside. But as I mentioned, just the way that I'm kind of personally wired, really was wanting more time at the 1,000-foot level of really focusing on the macro themes as well, and what are driving commodity prices, namely futures markets, day in and day out.
So when you were in that role as a merchandiser for the Andersons, what were your KPIs in that job? How were you evaluated?
So it was a lot of obviously, margin being first and foremost, buying grain and trading it at a profit was number one thing. I mean, there's no denying that everyone's in it to make money at the end of the day. But we were also gauged quite a bit on just outright volume of bushels secured from customers, but also maybe more nuanced of how we were securing those bushels. So as part of our portfolio, we did have a number of managed or structured marketing products that were the preferred method, I guess, put it that way, of procuring grain. Just as at the end of the day, we'd found that being able to ultimately service the customer, doing what's best for the customer, there was enough room there. It wasn't, mutually exclusive, that for the, one side to make money, the other side has to lose money. I feel like maybe that's an adversarial relationship that's pushed too much in grain trading, or is maybe a false narrative. We were very much of the concept that, we wanted everyone involved to be profitable, because ultimately we need the producers who are growing the world's food to be in business for year in and year out, in order for us to have jobs, is the bottom line. So that was one thing I definitely liked about where I landed, is there was an incentive there to not just secure the most volume you personally can trading, but also to do so in a way that max benefit to your customers. That's both producer customers and also end user customers. We had pretty deep relationships with a lot of feed yards, ethanol plants through central to western Nebraska areas.
Yep. So in a nutshell, I'd say that it sounds like the key thing you have to do as a merchandiser and a unit like that is basically when do I need to buy grain, how much, from whom, and at what price, roughly. Is that fair to say?
Yeah, I would say that was kind of the game in a nutshell, combined with a lot of time spent on the logistics. And I think ultimately that was maybe what drove me to want to move on. It's just your biggest, I'd say, challenge in the merchandising space is just time. It's a very time consuming job. You're on the phone pretty much 8 a.m. to 5 p.m. and didn't leave a whole lot of hours for being able to explore those, as I've mentioned, macro trends that I really felt ultimately, with commodity markets being more and more and more globally influenced, being what really drives price movement, isn't necessarily just what's going on in central Nebraska or even in Iowa or Illinois, but more so, and especially this year, as we'll get into, what's happening in Europe, in the Black Sea, and South America, and around the globe.
So, something I think's tricky is that you are ultimately, you're on the phone all day long. You have to make a lot of really important decisions on ultimately where everybody's got narrow margins. What tools did you have to help you accomplish those objectives?
So at that point, obviously it was a lot of Excel work, a lot of tracking things in Excel, and I would say, knowing what I know now about both Excel and other products and products I've been introduced since moving over to DTN, would have vastly improved that experience, I would say, especially tools like ProfitX, for example, and some of the more specific cash data that comes out of ProfitX is extremely helpful in finding maybe overlooked trends in the underlying cash markets within the greater grain trade, but also just some of the charting capabilities in ProfitX. And then more recently, the tools that I've been introduced to, such as the grain intelligence tool that DTN is working on, where that tool in itself, it would be a merchandiser's absolute bread and butter. I would believe anyone who had that on their desktop would probably be the first thing they'd open in the morning, and the first thing or the last thing they'd close before they left the office in the afternoon. Just being able to, I was always after, and something I tried to actually replicate in Excel to mix results. I was always after a satellite or map view of our grain positions when I was trading. Just because I'm personally such a visual learner, some people can look at a list, a customer list, and a position list, and organize that all within their brain to create a picture and easily see, where your grain movements need to be that day and that week. That certainly wasn't me. I'm, like I said, a very visual person. I needed it, kind of in map format, and I replicated it the best I could. But that's exactly what that grain intelligence tool is. And I think that's something that's going to make a lot of grain buyers' lives a lot easier here.
So tell the audience a little about the 6 factors analysis that DTN uses. What is that?
Yeah, absolutely. So the 6 factors was a concept, or is a concept, that was invented by my predecessors here. It's I believe back a number of years, 15 or 20 years, I would think at this point. But essentially, what it boils down to is trying to take what are obviously very complex organisms in commodity markets and boil them down to, in our case, 6 crucial factors that we track. In some cases, daily. We update them weekly, actually every Friday afternoon, heading into the weekend, to be viewed the next Monday. But overall, just trying to simplify as best we can in a marketplace that's obviously very difficult to simplify, what the major drivers are of price, daily, weekly, monthly. And it basically boils down to, whereas in our writings we have a very, what we call, fundamental view, which is your supply and demand analysis, whereas the 6 factors tend to focus more on the technical side, or actually what the price action is suggesting for the underlying market conditions. So looking through those 6 factors would be your non-commercial situation, which would be looking at your speculators' positions on the board of trade. What's the outsider, the big money, the managed money, think about the markets currently. The next would be your commercial outlook, in which we would be tracking both commercial positions, but maybe more importantly, the basis levels as well as the spread levels within the grain markets, which can be very helpful and often overlooked tools in really showing what grain buyers and traders throughout the U.S. truly think about the supply and demand scenario, and how nervous, I guess, they are on being able to secure supply. Next would be trend. We always like to have an idea of how prices have been trending. As the old saying goes, the trend is your friend. You try to look back. I tend to go 3 to 4 months trend is kind of my window. You could go wider or shorter, but that's kind of my benchmark. Obviously, past results aren't necessarily indicative of future results, but always want to know how prices have been reacting, given that fundamental news. Next is a big one, would be seasonality. Seasonality is something we rely on a lot in our jobs, as I mentioned and have mentioned several times, just with how chaotic markets can be, given how world-driven they are and news-driven more recently they are. Seasonality is one of the things that is year in and year out something we have to rely on. It's not always foolproof. There's years like 2025, for example, where you don't hit your highs at times where you expect, and you don't hit your lows where you expect either. But more often than not, for the corn market, for example, you tend to hit your highs in May or June. You tend to be looking for your lows in late August to September, somewhere in that time period. So being able to track that and how we're maybe breaking away or within those typical seasonal patterns is very helpful. And then the last two would be even more technically driven. One would be volatility. We use a 3-month volatility gauge just to show on any specific news or event how much could you expect within a certain range. We use a 2 standard deviation from a 3-month average. How much could you expect price to reasonably move and how quickly. And then we also use a price probability, which is looking at the past 5-year range and ranking the price within that past 5-year range. The goal there would be your longer term hedges would want to be dictated by something like that. Whereas if you're in the 90th percentile, for example, cattle through this year have had moments where they've traded to the 99th percentile of the 5-year range. And that's really more often than not going to be a decent level to take some risk management action. Whereas corn, we've been trending more in the 25 to 30% range. You're probably still wanting to be more base to base in your marketing right now. I don't know if I'd necessarily be going out and marketing a lot of 2027, 2028 crop at this point. But if we turn here and we get up over into the 70, 80%, maybe within the next 6 to 12 months, that would be the tool we'd be leaning on to suggest maybe farther out hedging at what would historically be a decent price for corn. Just a hypothetical sense there.
Yep. All right. We just had a WASDE report. Tell us about the highlights from that and the things that surprised you and surprised the market.
Yeah, absolutely. So the August WASDE, first and foremost, does come with a little added fanfare, I would say, namely because it is the first report where USDA sort of shifts their methodology. So for their yield estimates through the summer, beginning in May, June, and July, it's a purely mathematical yield at that point. It's what they call a weather-adjusted trend yield. So they're essentially just looking at the trend of the past 40 years or so of yields, adjusting by some weather factors and having the equation put out a number. In the August WASDE, they begin using their agricultural yield survey results. So they do have some survey results mixed in for the corn and soybeans, and they do use some field plot data, I believe, for the spring wheat this time around. So with that, and given just the time of the year with harvest just around the corner, it is one of the more followed reports. Historically, it does elicit among the more volatile reports in terms of price reaction, right up there with like the May WASDE and June acreage survey being other key reports. But anyway, this time around, we were coming into it thinking that it would lean mostly bullish for corn, soybeans, and wheat markets. And that certainly ended up being the case, especially for corn, and I'd also say wheat to some degree. But corn, there were some surprises. I would say for corn and soybeans, the surprise would be the 1.4 million acres added to each of those commodities, to the planted side as well as the harvested side. So this would be 2 years in a row now that USDA has surprised the market by increasing acreage considerably from their June survey result. Last year, ultimately, corn area would increase, I believe it was 3.7 million acres from the June survey result to the final number that they're using for the 25-26 marketing year currently. So we got 1.4 thus far this year. It'll be interesting to see, and maybe a point of nervousness among traders if we will see a continued increase here through the fall again in 2026. That being said, as was expected, the USDA did cut the corn yield and soybean yields just slightly for the soybeans, but a little more drastically, I'd say, on the corn side. I would also say that the DTN digital yield tour results were in the last week. We actually came in below both of the August forecasts according to USDA. So the DTN results were 178.5 bushel per acre corn yield compared to the 180.7 corn yield found in the August WASDE. For soybeans, we're looking at a 52.1 from the digital yield tour compared to a 52.7 bushel per acre in the August WASDE. So that may be certainly be interesting to track here through the fall, but it does seem like there's still I would say a lower bias to where these acreage these yields could ultimately land when it's all said and done. And the weather story isn't done yet. August and September finishing weather certainly matters a lot, especially on the soybeans. We're still in the midst of pod filling. But back to the WASDE anyway, ultimately we did see ending stocks for corn cut substantially. We're sitting now at just over 1.6 billion bushels is the forecast for the upcoming 2026-2027 year. That's down over 300 million bushels now from the June WASDE. So just 2 months has really taken a dent into that. That's being driven, of course, by very strong export demand in light of some of the international events. We're expecting demand for U.S. corn to remain very strong through this upcoming season. So ultimately, that would be a very steady cut from where we're currently sitting with corn reserves just under the 2 billion bushel mark. So stocks relative to use would be at 10.1%. That is starting to lean more to the bullish side as well. Typically, I use more like an 11% as kind of the middle ground, the neutral area. Once you get lower than 11%, you do start to lean a little bit more bullish in terms of corn. Unfortunately, on the soybean side, I guess the surprise was that we weren't able to cut ending stocks as many were expecting. The USDA, with that added acreage, even with the lower yields, did increase production, is expecting a record soybean crop of north of 4.5 billion bushels. Ultimately, that increased the ending stocks outlook by 10 million bushels only. We did see some offset with increased crush demand. But that being said, there are reasons for optimism for the soybean market, in my opinion, namely the export demand as well. This year has featured, obviously, the return of China as a predominant buyer of U.S. soybeans after the trade war year in 2025. So thus far, they appear right on track to hit the volume goals set out by those trade agreements back in October of 2025, and then again when President Trump visited Beijing in May. So so far, so good. And if it continues on this pace, it would suggest that we will see higher export demand than what USDA published on the August WASDE as well. And then lastly, just to speak quickly to the wheat, no real changes on the world side in August. It is still considered one of the lowest wheat outputs for the U.S. In modern history, actually going back to 1970, since we had a lower wheat production in the U.S. Really just a drought-stricken crop through the last winter. Notable fall-offs in production across the heart of the wheat belt. But it's increasingly become an international market. The Black Sea situation and the uptick in attacks on shipping and port infrastructure through the late part of July has really sent those markets into a frenzy. Unfortunately, the WASDE didn't really offer us much insight, at least in terms of what USDA thinks could be the bottom line effects of that ongoing war. They did cut Black Sea exports just slightly by 2.5 million metric tons, but they also offset that within the world market with some higher exports from competitors such as Canada and Kazakhstan, for example. So unfortunately, still, I'd say more questions than answers at this point in terms of how we could ultimately see wheat fundamentals shift given that situation in the Black Sea. So that'll be something that I think a lot of traders will probably flip right to that world wheat page in subsequent WASDEs as long as this situation goes on unresolved in the Black Sea.
Yeah, wheat prices are up quite a bit this week, correct?
Yeah, absolutely. Last I looked, even from right before the release of the WASDE here, about 50-60 cent move in the most active Kansas City wheat futures, which would be the September contract. So very strong movement, and I think it's felt like there is bullish momentum brewing in that market all through August. And I think now that the WASDE is kind of in the rearview mirror, and maybe some traders were nervous that it would come out surprisingly bearish, didn't want to get caught on the wrong side of a trade. Now with that report in the rearview mirror, it seems like we are seeing bullish traders step back into the market with a little less caution about building some length here with the attacks, as I said, in that region. Really no sign of slowing in attacks against port and shipping lanes in the Black Sea.
Yeah. On the corn side, what are kind of the major drivers internationally for international corn demand into the U.S.?
Yeah, absolutely. So this year, it all hinges really on Europe. So Europe, in the midst of a historic drought through 2026, across France, particularly, just days on end of over 100 degrees seen in June, July, and continuing as recently as early August as well. It's just really been a hard hit on their developing corn crop through that time period. Their wheat crop got through a little bit better. It did take the top end off of yield potential, I would say, but not to the degree of corn. So again, the USDA tends to kind of slow play these things and wait for field results before they take their biggest chunks out of their estimates. But they have lowered their European wheat production by 5 or 6 million metric tons in the past two WASDEs, including 3 million metric tons in the most recent August WASDE. It's down right around 50 million metric tons now, but there's rumors and some talk out there that you could see something even smaller into the 40 million, 45 million metric ton area. As a result, it's going to really shake up global feed grain demand, particularly in Europe. You're probably going to see more wheat withheld now for feeding purposes, and obviously more corn imports as well. Normally, it would be a price mover either way, but normally maybe not so much, because you would think Ukraine being right there and being a major exporter of corn would be able to fill that demand, especially with the Ukrainian crops looking actually pretty good down the stretch here in 2026. But given that situation in the Black Sea and the logistical struggles of getting corn into continental Europe, that's really going to open the door, in my mind, for that business to really be between the U.S. and Brazil, and maybe Argentina as well. But speaking to Brazil, we continue to see more and more internal demand for corn. The ethanol industry in particular is ever expanding in Brazil. That's going to hold or increase the demand locally for that increased corn production. Less of it will be hitting the world market, whereas the U.S. in a very good situation with some of those excess reserves we've seen in the past few years, of now being able to maybe unload some of that, those extra stockpiles, on a world that continues to see corn demand increase year in and year out. And we are sitting at a very interesting spot in terms of world corn fundamentals. If you remove China from the picture, the world corn demand situation relative to supply is among the tightest we've seen in the past 20 or so years. The only years that would be really close to it would be like 2020, and also down into 2011, 2012, years we associate as being very bullish years within the corn market. So it's an interesting scenario, especially to be sitting in August, a time of the year where, seasonally speaking, you'd be feeling some price pressure this time of year ahead of the harvest. But the global situation certainly argues that the supply situation isn't quite as comfortable as we have been in maybe the 2023, 2024 type years.
I mean, you got at kind of one point about the DTN digital yield tour yields coming in a little bit below where the USDA set it at. Any other big surprises from the DTN digital yield tour?
Yeah, I would say I personally was surprised that the corn yield came in that low. I was personally penciling a number lower than USDA, but I was more in the 180, 181 type numbers. But going through the state by state results, there were only a few that really raised question marks to me. And to be honest, the ones that did, I thought were maybe overestimated. And most one that comes right to mind would be North Dakota. The yield compared to the 5-year averages were kind of right in line with an average yield for that state. And certainly the drought monitor and recent rainfall through late June and into August would argue against that. It's been a very challenging and drought-stricken year for the Northern Plains. And so I think that would be, even give me maybe a bit of a lower bias certainly from where the USDA is at their 180.7. But really, I think I think the DTN numbers could prove to be right on the money this year with some of these late season challenges. It'll be really interesting to see how it plays out with the rainfall through August. We do have a decent rainfall outlook across the heart of the Corn Belt, but that being said, some of those fringe areas, the northern plains and even down into the southern Corn Belt, look to be dry through this month and may have some troubles there finishing the crop at harvest.
So historically, many businesses have really planned around USDA reports. Is that still enough in your view?
Yeah, so I think obviously the USDA reports remain the benchmark. So I kind of have a running joke with myself that there, in my opinion, there's two types of analysis. You're trying to guess the numbers of what will actually happen, or you're trying to guess the USDA numbers and the patterns in which the USDA operates. And that's not a jab against USDA in any means, but they do operate in predictable patterns sometimes in how they change estimates through a certain season. And I think ultimately the USDA numbers are the numbers that hit the market and the wide, as mentioned, the benchmark number that's going to trade. But in between those pivotal events and those events of obviously very high volatility and liquidity within the markets, that's the great part of being in the information age. Is there's certainly no shortage of indicators to track in between, and this is really going back to the six factors is what we've strived to do with those weekly update of those what we view as the key drivers of price. Independent of really any fundamental analysis, is what is the price saying that the market conditions currently are. But in terms of fundamental data, there's also things to rely on, such as the weekly export sales report is one of growing importance. The EIA releases a weekly ethanol rundown. So you do have quite a bit of numbers at your disposal. Not all of them are reactive to the market, or the market's not reactive to all of those reports on a week in and week out. It's really kind of just price drift sometimes between those key USDA reports. So, yeah, I think the USDA reports obviously still kind of your cornerstones of trade. But as I mentioned as well, it's becoming just more and more of a world and event-driven thing as well, and a headline-driven thing. Whereas the wheat market this week's a perfect example. We looked like just yesterday we were off to a 20+ cent gain in wheat. Ended up giving all the gains back by the close on some rumors that Ukraine and Russia would be working out or were in touch to come to some sort of agreement for safe trade through the Black Sea. That obviously ended up being false, or not a lot of faith in that being the truth, as indicated by today's price action. So I think honestly, at the end of the day, the prices themselves tell you a lot, which can sound kind of counterintuitive. We spend a lot of time looking at the data, trying to say what does that mean for price, when sometimes the price tells you what the underlying situation truly is.
So what are you going to be watching for over the next several weeks?
Yeah, so that's a great question, and it'll be all the factors that we've talked about. The Black Sea thing and the European Ukraine trade dynamic is first and foremost. I think kind of the bullish foundation to the rallies we've seen, in combination with obviously the weather stress towards the end of July. So those will really be in tandem. I think the storylines to watch. How does weather finish out through the critical pod filling stage for soybeans, and also grain fill stage for corn in August and September? And how does that situation in Europe ultimately affect the bottom line for demand, which we expect will be a strong foundation of demand for U.S. crops? That'd be on the grain side, but also for the soybeans, it's really going to be an arm wrestle between where production lands and where the export demand goes from here. We're really kind of on the fence of where you really can't see production slip much further than it's currently forecasted with how demand could go through this next season before you start really straining the ending reserves to levels we haven't seen since the years immediately following the COVID-19 pandemic, the 2021, 2022 type years where we obviously saw soybean price and corn price and wheat price much higher than where we're currently sitting today. So I think that'll be really the main factors to watch here. It's all going to come down to weather and geopolitics, I believe, at least in the next 6 weeks, I would say, to 2 months. And then we'll be into the harvest before we know it. So I would also say, just from a seasonal standpoint, might not be too surprising to see some pressure on these prices, regardless of the underlying fundamental situation. But I'll personally really be looking at for the price reaction post harvest and how of a reaction can we get once the harvest pressure lifts and we kind of have an idea of supply. Will be a really good indication of where this thing could go into the early months of 2027 as
well. Rhett, one of my takeaways, I think, from our discussion today is, the USDA WASDE report, especially the August one, is still, very much a benchmark. But as always, there's so many factors that go into driving both, what's happening with prices and then the actuals themselves. That's certainly what I value about being able to follow you. I mean, that's your job all day, is to track all these different factors and consolidate them for our audiences. Also, something I love about working at DTN is that we sort of sit in a place where we have all these data points and models and so forth at our fingertips and can watch it all. So, Rhett, look, thank you so much for joining us today. And thank you, the audience, for listening to DTNsights. If you want to learn more about and be able to track all of Rhett's market analysis, do subscribe, if you're not already, to MyDTN. You can visit mydtn.com, or you can do a Google search to request a MyDTN free trial. We'll see you next time on DTN Insights.